Hey guys, today is it Wednesday? Let's just do a closing market update. The thing that really stands out to me right now, especially in the bond market, is just how high yield is. So I just did a post on this, but I think the high yield market is really vulnerable up here. I mean, just the way that the price actions bounce back, where it is as far as the cycle, especially within the longer term range. If you're long any high yield junk bonds, you want to be getting out of those. I mean, I realize some people can't be short, but I think the edge is definitely to be short. I mean, I think we're due for another multi-month move back lower, and I don't think that's going to bode well for risk if I'm right. I mean, this cycle if you just look at the high yield ETF HYG, I mean, this range it's stupid high. I mean, we're up here, percent D, that's up here around 95. Every time it's been up there, this was 91, the market sold off. This was up here around 93, 94. High yield market got crushed. That was in 2011. All right. Here it rolled over, it was only at 87. And then this is coming right off the lows after the crisis. So I mean, the last time the market was this high, it's nasty correction from here. And this is the monthly cycle, so it can come all the way back down here to 50. I don't, maybe after this type of rally, you don't expect it to get all the way back to the lows, but about halfway. So when we go to the weekly, this is your 2 standard deviation long-term risk range, all right? I mean, I'm going to try to work a long-term short. I mean, I'm going to try to work it all the way back in here. But you can see the weeklies are already kind of starting to roll over. You can see that on the stochastic cross. You got to be aware that the 8 here is still rising. That shows the immediate term trend. But when you zoom in even more on the weekly level, I mean, these three tight, narrow range bars, you usually get these tight, narrow range bars at the bottom before an explosive move, and then at the top. So if we start to see this market crack these lows from the last 2-3 weeks, then you got to look for a move back to 85, 84, and into the Brexit lows down around 82. So anything's possible. But even if you look at the move, I guess if we zoom out here, okay, if you take this entire move down and you think of that as one bearish candle, because it's just a matter of dividing up the time. If you went out on a yearly chart or like a quarterly chart, this might be one bearish bar. And you take about halfway of that move, it's kind of where the market's retraced to. So that's just how markets move. I mean, it's going to be tough for it to retrace this entire move down, especially after all this pain. It was the number one topic at the beginning of the year, and all the distress in at the energy names. It's just, we're at the big picture. I mean, we're late within the credit cycle. I mean, we're late within the economic cycle. We're early within the credit cycle. So if you want to be getting long bonds up here, I mean, good luck. But then this next move is probably down. The probability is very high that the next move is down. All right, so I mean, I've been trying to trade around my position, being short here. It hasn't really worked since Brexit at all. I thought once we got this move here that we would finally roll over, and it's just been a squeeze ever since. So we're long mostly via puts. Today we were talking about doing 88 and 90 put ratio back spreads with some of my guys. That makes a lot of sense. So we're going to keep trading it around on the hourly, but that's my opinion of the high yield market. If you look at investment grade, you just want to use the ETFs that are pretty common. If we go top down, you start with the monthly level. Right? This defaults to 1 standard deviation. This is high within the long-term range. You do not want to be a buyer of corporates up here, okay? I mean, it's just, especially not long-term, all right? I mean, this is so self-explanatory. Look, bottom of the 2 standard deviation regression channel holds. I explained this 3 sigma rule last week. The majority of your data is going to lie within 2 standard deviations. That's just the way it is. It's true in statistics. Market price action is very similar. So you wanted to be a seller in 2012, seller in beginning of 2015. And you need to be a seller again now. Go to the weekly. Look how high we are in the monthly. I mean, the monthly level is just, it's goofy. Go to the daily. Oh, sorry, let's go to the weekly. Weekly, all right. Still bullish. You can't argue with that. I'm just saying that this was good. If you were bullish here on this candle, this real money candle, or especially when we took out these highs and the TMS, what should I call the TMS pivot, shifted to new higher highs, which made this structure bullish, I'm fine with that. But now you got to be a seller. All right, the daily level, if you want to get more granular, is going to be when you take out these higher lows, 122. Then you should look for a move. You also fail to hold these bands. This is your pivot, 122. If you break that, we're going back to 118, 117. I'm not saying in a day or two, but several weeks to a month or two. I mean, that's what you should expect. That's where the probabilities lie. And then if you look at treasuries, it's quite a different picture. We're high there long term within the trend, no doubt. No doubt long term. I mean, this is just a massive bull market. This is only 1 standard deviation too. So I think that makes a lot of sense to be aware that this has been a strong trend. If you go to the weekly, look at the cycles are different. Pretty low on this cycle. If you go to the monthly up here, it's still high, but not as high as I mean, I don't want to argue with the monthly. That is overbought, and I'm very aware of the bubble in bonds. You go to the weekly though. It's a different spread. High yield and investment grade is much more overbought. All right. Even if you look at something like utilities, which looks like a bond from the equities perspective, that's oversold. You can look at the spread between financials and utilities. And I'm much rather be a buyer of utilities right now. Same thing with treasuries. I mean, it's basing, but we're not extended overbought. All right, guys. So I think I kind of made my points there on bonds. I think that's probably good for tonight. I'll catch up with you all in the morning.